Hi, I'm Howard Marks, co-chairman of Oaktree Capital Management. Today, I'm with several of my colleagues, and we're going to talk about the credit markets and relative value. With me today, Justin Guichard, who is the co-portfolio manager of our real estate debt and structured credit area, Madelaine Jones, co-portfolio manager of European high-yield bonds and senior loans working in London, and Armen Panossian, who is the head of performing credit for Oaktree, which includes loans, bonds, and direct lending, public and private, U.S. and international. The first thing I'd like to do today is ask each of you in turn how you're thinking about the environment. I mean, we're in an environment I would say that we've never been in before. We've had crises in the past, but never surrounding personal safety to this extent. How's that affecting your mind and your thought process, and how are you factoring that into your decisions? What's your thought about the environment? Justin, maybe you can start.
Sure. My perspective is that there obviously are significant reasons for concerns globally. We're looking very actively at opportunities where certain situations may be oversold in reaction to this type of virus. The immediate impacts that we're seeing in terms of where these liquid securities are trading, the most significant are to the hospitality industry, which we all know and expect is going to be impacted by coronavirus in a very significant way, at a minimum for the next couple of quarters is our expectation. Correlated, but maybe not as directly obvious, areas like retail. So the question is, will individuals continue to go to malls, or will shopping online become more significant in terms of acquiring goods? And so we are seeing meaningful declines in value in high yield bonds and some mortgage-backed securities in areas that are specifically focused on those types of transactions. The sort of second order effects that we're thinking about today include areas like office, industrial, multifamily. Are there going to be job losses in the future, and could a sustained period of economic weakness contribute to a decline in consumer credit, really where the consumer has been powering our economic engine, for a number of years now? And so those are some of the other things that we're considering as we're evaluating opportunities in traded securities.
Very good. Madelaine, you were in London as of 40 hours ago. Tell us about the environment there and how the folks there are looking at things and how you're looking at things.
Well, I'd say generally the market really dealt a significant blow with the spread of coronavirus, and then the oil price shock on top of that, a blow upon a bruise effectively, and really unhinged a lot of investor psychology. So we're seeing some significant moves there. I think for us, you say we haven't seen this kind of event before, but we have seen similar events, and we've seen moments with SARS, with terrorist shocks. We've seen some, what I would say, temporary but sizable, significant impacts on the market, on certain companies, on consumer behavior. And then potentially you see a long-term effect of that, longer term, if it feeds into the cycle and a downturn in the cycle more progressively. So we need to delineate where we are with that. We need to delineate where we find companies which will be able to withstand what could be a temporary shock, and companies where we think they really cannot face that kind of pressure. They have liquidity constraints, they have high financial leverage. And we've positioned ourselves pretty defensively going into this year. With spreads where they were, it didn't seem a moment in time to take excessive risks. So I think now we have to be alive to both the risks and the opportunities that we can take with that as our base.
Well, it's interesting you should say that. I've been thinking a lot lately about a memo I wrote about 20 years ago entitled, "You Can't Predict, You Can Prepare." Certainly, everything that's happening today was unpredictable. Yeah. And in fact, 2 months ago, most people couldn't think of a catalyst that could bring about a recession or a correction in the markets. But I think the key is, as you indicated in your remarks, we at Oaktree have felt that even though we couldn't predict the events, we could prepare for them. Now, that sounds like an oxymoron, but I think that when the markets are such as they were 2, 6, 12, 36 months ago, we can conclude that it is susceptible to an unpredictable black swan, and consequently time to pull in our horns a little bit. And I'm glad to say that I think we did. We'll see if it works. Armen, what about you? You have oversight over so many areas. How are you thinking, and how is that influencing your actions?
Sure. So on the one hand, there's the consideration of risk to life. And I'd leave that to the physicians and the CDC and the World Health Organization. On the other hand, there is economic impact. And the economic impact, there's some that are fundamental and that will be potentially lasting for the short term and maybe even longer in particular industries. And then there's the technical. We have been seeing meaningful price movements, both down and then back up and then back down again, but we're not seeing meaningful amounts of dollars or securities trading. What that means is the market is in price discovery mode, and no one knows what's going to happen next. As a result, it seems that participants in the market, especially the trading desks at the banks, are making markets that are quite wide to figure out where the real bid and the real willing seller lives.
If we can make superior distinctions and take advantage, that's what we should be doing right now. What's happened, Madelaine, I'll start with you. What's happened with prices, yields, spreads, and volumes in your market?
Well, most significantly, so I'm covering high yield and loans. Quite an interesting distinction between the two. Certainly in high yield, specifically in US high yield, a very significant price downdraft. As Armen says, maybe not on the basis of much volume, but prices being marked down. So significant on the energy. And US high yield, over 10% is energy related. Then in selective other industries as well, travel and leisure. In Europe, we don't have so much energy. We are saved from that, but we do have some heavy cyclicals, some autos, particularly our German autos, who are really exposed to the Asian consumer, and they've taken a hit as well. But the baby in the bathwater we were seeing at the beginning, industries like telecoms and cable in Europe, that really shouldn't make sense because there's no real impact on an industry like that.
Is that how you see your markets, Armen?
Yeah, I mean, I would say that in energy, that's obviously the biggest downdraft, especially in high yield rated energy, so below investment grade energy. Even in investment grade energy, we are seeing meaningful price degradation on little volume. It's yet to be seen how volumes may follow the price movements. I think that may be an interesting area where there is baby out with the bathwater, even in energy-related investment-grade credits. The reason I say that is because not all investment-grade energy-related companies are created equal. Some of them are energy production and exploration businesses in the United States that may be structurally impacted by what's going on in oil and gas prices. But there are other companies in the United States that have infrastructure-oriented assets, such as pipelines and refineries, that are also seeing similar price degradation.
Justin, in the area of real estate debt, where you work, that includes both whole loan mortgages, private, and mortgage-backed securities,
That's right.
Public.
Yep.
I would guess, given the price discovery issues that Madelaine and Armen have talked about, you're probably not seeing much trading on the private side yet. What's going on there in publicly traded real estate debt securities?
As you highlight, we invest in both private loans and traded securities across both commercial and residential transactions globally. As you correctly highlight as well, effectively the private loan market in many respects seizes up during periods of significant volatility. If there's not a strong catalyst for an owner of a real estate asset to refinance that position, then he or she may just hold back from the market, and therefore you see volumes effectively shrink. You know, we like to think of this structure as effectively providing a call option on market volatility, because a lot of times we do see bargains in traded securities and real estate debt, both in mortgage-backed securities and in real estate-related corporates during these periods of price discovery, and are in a position to take advantage of those bargains.
Historically, the greatest bargains and the greatest price declines have often come at the expense of forced sellers. A fund gets a withdrawal, they have to liquidate securities to meet it. They have no choice. And this comes under the heading of the technical conditions that I think Madelaine mentioned before. So my question briefly for each of you, in your markets, are you seeing any forced selling, panic selling, that kind of thing?
When I was in the distressed group in 2007 through 2010, we saw a lot of forced selling. We saw it from the bank trading desks. We saw it from special leverage vehicles that had mismatched asset and liability maturities or duration. We had mark-to-market vehicles. Today, we really don't have very much of that. And in fact, in some asset classes, like senior loans, the retail portion of the ownership base of that asset class has meaningfully diminished as well over the last couple of years. So generally speaking, in the last few weeks, we haven't seen a tremendous amount of forced selling. I think the reason for that is the bank trading desks no longer have the size of books that they used to. We, generally speaking, do not have levered vehicles that are mark-to-market in nature or mismatched in terms of asset and liability duration. And we don't have, as of yet, a meaningful amount of panic in the markets that is causing people to want to go to cash in a drastic way. That could change very quickly. The retail component of some of our markets may see redemptions and outflows. In senior loans, even though the retail part of that market is not as big as it used to be, the trading dynamics and settlement of trades in senior loans is quite unpredictable in nature, and therefore some of those managers may feel the need to sell in advance of redemptions, and so we're watching that very closely.
I think it's very interesting to note a couple of things. Number one, the retail senior loan investment has been shrinking for
a few
years, but the senior loan market as a whole has been growing thanks to the strength in CLOs.
That's right.
Then important point number two is where we saw the worst of the action in '08 was market value CLOs violating their limits and getting what we call BWIC, bid wanted in competition, and sold out because they got a margin call. Almost all of those disappeared. Virtually all of the non-market value CLOs, that is to say, the cash flow CLOs, where any margin calls had to be a function of a failure of cash flow, those all made it. And so that correction, that phenomenon has been corrected. We don't have market value CLOs anymore. We only have cash flow, so they're unlikely to get into as dire a situation anytime soon. Technicals in your market, Madelaine?
Well, similarly, there aren't the same kind of margin call debt structures that we had through that crisis period. Of course, there's the ETFs in European high yield, and you do worry about the marginal trade, who the marginal buyer is to support that, and we hope to be one of those buyers. But really, a lot of the debt that was placed last year was placed at such low coupons, so supported by the central bank's policies, that they have to take quite significant prices down to start to attract a buyer in. So even a small move on the ETFs can move some of those prices back quite considerably. But no, not really a landscape where we're seeing massive forced sellers. I think the CLO product, if you take that at the extreme end, could start to have pressure because they have ratings they have to care about. And if the CCC bucket grows, if downgrades increase at some point, that's going to pressure some vehicles. But as we stand today, that needs quite significant increase in pressure. But as we look at a part of the market which could be exposed, a CCC or a weak B3 loan could feel technically weaker right now.
And Justin, anything?
Yeah, we really haven't seen the type of forced selling that I experienced, shortly after I joined Oaktree in 2007. Today, the market setup is much more robust. Frankly, many of the credits that we're investing in, those investing more senior in the capital structure, they're very strong hands. And so we really haven't seen any significant volume of mortgage-backed securities coming out as a result of these issues.
I think that one of the themes that I detect is that we've been saying for a while that we don't think we're in a bubble. And in many ways, I think that your comments reflect that. The structured vehicles are less levered and not subject to market value margin calls. the owners, the investors are less levered. We may not get the kind of panic selling that produces the opportunities that we like so much, but we'll see. One thing I think about is the ETFs. People went into ETFs, I think, among other things, because they were told they could get out anytime. They might have taken that to mean they can get out at an attractive price anytime. And if they start to be disillusioned in that regard, then we'll see what happens. Which of the markets, as you look across all of them, do you think are the most attractive today, and which are the least?
Well, I tend to like markets that are least efficient and are creating opportunities to buy good loss remote securities or positions at attractive yields and attractive prices. And today, I think everything has some measure of dislocation, but the area that I think is probably most dislocated from a technical standpoint, that is in a way separate and apart from the fundamental underpinnings of the asset class, are actually CLOs in structured credit. CLO, specifically BBB and BB rated CLO tranches. The reason I say that is because the buyer base for BB and to some extent BBB rated CLOs are an absolute return buyer. They are not for the most part, a levered buyer. So with the downdraft in LIBOR, the unlevered return of that asset class is now lower. In addition, with coronavirus, with oil and gas prices, there is a perception of risk in the senior loan market that there may be an increase in defaults and an increase in losses, and therefore more junior tranches in the CLO capital structure may absorb such losses. However, when you dig into how a CLO is built, there's usually between 8 and 10 percentage points of equity beneath all of the debt tranches, which means that you would need to have that level of actual losses eat through the portfolio before you had $1 of loss on the BBs. That's pretty hard to do. The reason it's hard to do is most CLOs have between 200 and 300 unique issuers in their portfolios. You would need to see a correlated default experience and loss experience across a very large portion of the global economy to see 8, 10, 12, 15 points of actual losses eaten through to destroy all of the equity value. In addition, as equity value is being destroyed, CLOs have self-help provisions in them that result in a diversion of cash flow that would have gone to the equity to be redistributed into delevering the capital structure of the CLO by buying additional assets or by interest payments. So instead of net interest margin going out to the equity, that net interest margin is redirected into first buying additional assets for the CLO, and then second, deleveraging starting with the AAA down. So as bad things are happening in a CLO, the leverage is also declining in that CLO. And therefore, it is my belief that the actual losses suffered by BBB and BB rated securities will be minimal, if any. And right now, with the technicals in the market around LIBOR and around these underlying potential fundamental risks, we're seeing a meaningful price degradation in those two asset classes.
So Justin, you are co-PM on the structured credit side of our business. Do you have cash, and are you spending cash?
We are drawing cash from our limited partners and spending cash and repositioning the portfolio to take advantage of just the opportunities that Armen's highlighted in CLOs. To his point, we're very favorable on BBB and some BB high quality CLO paper where we've seen meaningful declines in price and therefore really attractive yields. On the real estate debt side, there is a saying that regulators are really good at putting out the last forest fire. So what we saw post global financial crisis is regulations like Dodd-Frank and Basel III really go after sort of the irresponsible lending practices that we saw in real estate globally in the lead up to the financial crisis. So we're focused for our private funds right now on opportunities that we characterize as being regulatory driven. So certain parts of the residential first mortgage market here in the United States, certain parts of the commercial mortgage-backed securities market that are subject to significant and stringent regulations and create a lot of inefficiencies in those markets are really attractive to us today. Looking on the more liquid credit traded security side, we are seeing some bargains in hospitality, we think. But a lot of what we do at Oaktree is involve the entirety of the organization that has knowledge and expertise in certain areas in order to help us to make good credit decisions. So we have a 55-person real estate team that was highly experienced investing in hospitality through the financial crisis. And so we're leveraging a lot of that knowledge and expertise to make sure that we're investing in assets that have the transparency that we require, the downside protection that we require, and that we think, frankly, will weather the storm here in the next year or so.
Good. Madelaine, what about your markets? What are you doing at the present time?
Well, we are looking out for those opportunities. Certainly names which we couldn't buy that we liked last year have now become in an interesting zone, and we can start to pick those up. I don't think it's a time for us to go headlong into risk-taking. We need to see a little bit more about how the coronavirus evolves, what the actions of the central banks are going to be, what fiscal stimulus is going to come out to shore up potential for a further degradation of the economic climate. See how that goes. But selectively, we've been playing a defensive position for now. Now that the spreads have widened, there is a point to owning some of those names again.
Here's the question I've been dying to ask you for the last couple of weeks, all three of you. As you know, for the last few years, our mantra has been move forward but with caution. We've been essentially fully invested where we could become fully invested. But applying even more caution than our norm, which is cautious. Is it making a difference?
Staying cautious, absolutely. For the last several years, other than some very short periods of industry-specific volatility, it's been a bull market. And therefore, staying cautious has been challenging at times, but volatility, managing volatility and managing downside has been job number 1, 2, and 3 for our performing credit strategies at Oaktree. Today, given the diverse nature and downside protected conservative positioning of our portfolios, we're able to take advantage of dislocations that are occurring.
Madelaine and Justin, do you agree?
I think last year, was a real risk-on rally, and especially December, where there was a grab for risk, and Triple C's did so very well. And our portfolios were not destined to do brilliantly in that on a relative basis, but to give up, a little bit of that return to protect yourself against what's happened. And I think that justifies what we've been doing for so long now in our strategies.
Good. Justin?
And in global credit, which we all participate in, real estate has recently served as effectively a volatility dampener in that portfolio. So we've mitigated some of the volatility we've seen in other asset classes, particularly in the fourth quarter of 2018 and the like. But to your earlier point, sort of in line with our broad Oaktree level views on positioning, we ramped down, or I should say reduced the volatility or expected volatility by positioning our portfolio to have reduced exposure to certain asset classes. So let's take hospitality as a good example. You often like to say that investor minds are fairly short as it relates to historical experiences. And in our 2013 vintage closed-end fund, we frankly were getting paid for hospitality risk. So in good credits where we felt comfortable, other investors maybe had a memory of what had happened during the global financial crisis, and we found excess spreads in those types of transactions because of the concerns, or maybe hangovers, one way to put it, from what had transpired in the recent past. As the years went on, those memories got shorter and shorter. And so as we were investing our more recent fund, we took down our exposure to hospitality by about 2/3 because frankly, risk premiums collapsed because it was a bull market. And so we feel very comfortable with our current portfolio positioning because we adopted that more conservative attitude in recent years.
Well, memories of tough times certainly do tend to fade when everybody's making money. I'd like to thank my colleagues for being with me today and participating in this conversation. I'd like to thank everybody who's watching for taking part.